to today's special webinar event. I'm Terry Ryder, founder of hotspotting.com.au, and my special guest today is Jason Paetow from AllianceCorp. Hello, Jason.
Hey, Terry, how are you?
Very well, very well. You're in Melbourne. I'm in sunny Bargara in Queensland, and
Yes.
We're actually at very opposite ends of an extraordinary real estate market. I'm in one of those regional markets that are they're going off at the moment. You're in Melbourne, where things are managing to do remarkable things despite all the restrictions.
Absolutely. And look, I've got to say, it's actually sunny down here in Melbourne. It's actually quite warm for a change as well. But yeah, very different experience for property buyers down here at the moment with our lockdown. So we've got buyers that can't even get out to properties. We're in a complete lockdown at the moment, but still really incredible times. And we're going to obviously discuss that together in terms of how our market has performed since COVID sort of kicked in. So we've got some great stuff for the viewers.
Well, I think that the trend today is really to address this. The reality that a lot of people out there are very puzzled, and I get these questions all the time. I was at an event in Harvey Bay yesterday. Everyone's very puzzled as to how come we've got these incredible markets when we're in the middle of this pandemic. And I think the key message for people to understand is rather than what media is telling us, which is prices are rising despite the pandemic, what you and I know to be true is actually prices are rising because of the pandemic, because it's unleashed forces that would not normally be present. And those very powerful forces are the key elements that are causing the strong demand and the strong prices. So that's what we're going to discuss today, and I think you've got some slides that will help that process. So.
Absolutely. So I thought we'd just run through some stuff. I'm a super visual guy, so where I'm most comfortable is at the whiteboard with my clients, running through all various strategies on the whiteboard and running through some data and stuff. So I thought what we might do is just bring up some very high level. We're not going to go down the rabbit hole with some of this data, but just some visual aids there, just for some of the viewers to help and assist with sort of what's happening with the markets moving forward. So look, I will just share my screen. And you should see that coming through now. And we'll just get this button out of the way. There we go. All right, so, at the top, hang on. All right, where are we? There we go. All right, so how the pandemic is driving the property market, property boom. And just for the viewers there, just in terms of who I am, I'm obviously Jason Paetow. I started the business, AllianceCorp, about 13 years ago. And what we do is we sort of specialize in helping investors build portfolios right across Australia. So we help with the education. We've got property wealth planners. We have an education team. We mentor, we coach our clients. And we have a research and acquisitions team. So we buy all sorts of properties, established properties, new properties, off the plan properties, and we target all the markets nationally. So we've got offices in a range of different states, and we sort of specialize in the field in terms of helping people build these property portfolios. So look, I guess going back to the start of 2020, when we started to get a lot of those reports coming in from China in terms of what was happening there with the virus, it was very nerve-wracking at the time. No one knew what to expect. But in terms of understanding how the pandemic has affected our markets, I guess what we have to understand is what was the shape of our markets before COVID hit us. And as we sort of ran through with a lot of our clients coming into the end of 2019 and start of 2020, we were coming out of a market recovery. So 2019, we saw a little bit of a dip in our markets. But then through that recovery, all forecasts were pretty strong. You can see on the screen, this was from SQM at the start of 2020. And pretty much every market there was looking quite positive. Moving forward into 2020. Now, a lot of that had to do with shortages of supply. We had still very low interest rates. We had strong confidence in the market. There was strong demand. Vacancy rates were very low. So everything was moving in the right direction. And as you can see from the screen there, coming out of the end of 2019 into the 2020, you could see there that nationally, a lot of our key markets there were on the rise. So I imagine you would have remembered those times too, Terry?
Absolutely. Look, I thought throughout 2020, contrary to those dire predictions that we were getting, particularly by major economists, that But markets were actually performing remarkably well. And I think if you go back through the month-by-month statistics for 2020, you'll note that there are some markets that Canberra recorded some level of price growth every month of 2020. Adelaide, I think every month except one, and many of the regional markets as well. So we actually had, the exceptions of Sydney and Melbourne, some pretty strong performance. We were starting to see the early signs in 2020 that real estate was going to outperform amidst the pandemic. But we continue to have those negative predictions from people who really aren't specialists in the field like yourselves and don't, I think, fully understand the dynamics that drive real estate markets. But as we got to in the second half of 2020, we increasingly saw the emergence of the dynamics that were going to create the extraordinary nationwide boom that we have now.
Yeah, absolutely. So everything was rosy, everything was looking good, and the foundations were very strong. But then, look, COVID hit us, and then through February through to March, as we started to see those case numbers rise here in Australia, it became very concerning to a lot of people. And then, of course, then the news articles started to flow. We started to see a lot of concerns out there in terms of a market crash. A lot of predictions there were 10, 20, 30%. And look, we had a lot of clients calling into the office, very concerned. We help people buy properties all over Australia. And for some of those clients that had just purchased, the question was, should I pull out of this purchase? Some of those clients hadn't settled, or they're still subject to finance. And we did try to explain them that, you've got to be very careful. You don't make your investment decisions by what the media tells you. I think most people can understand that to get a good story out there, or to get someone to click on that article, they need to sensationalize what's really happening out there. So it's either the market's absolutely booming or the market's crashing. You never really hear any reports about, oh, look, the market's just ticking along doing what it does, because that's just not newsworthy.
It's always a crisis of some sort, Jason. Even when the market's booming, that's a crisis as well, because they introduced the concept of an affordability crisis, and young people will never be able to afford to buy. And now, organisations like CoreLogic seem to be competing to be the first to call the end of the boom, and they're looking for every justification for a screaming negative headline in each month, each set of monthly data.
Absolutely. And look, we sent out a lot of information to the clients. We showed them examples that this is just normal. This is what the media do. Like even prior to COVID, you can see some examples there from leading economists and authors. And look, 60 Minutes loves to jump on this sort of stuff. And every time these guys come out and it hits our headlines of some significant sort of market correction, the markets just do the opposite, as you can see from the graph there going right back to 2010. So clients need to be very careful, because people will make those decisions based on those news reports. And what we found was interesting was, particularly because we buy all sorts of properties, Terry, some of those properties we target in the growth corridors, where we buy a new home. And we had clients calling us up who just purchased, and we just said, look, you can't focus on the media. What's happening with COVID, it is a concern, but it's not a fundamental driver of the performance of our property market, and it's going to be short-lived. Although we're in unprecedented times, I think most people sort of agree that we will get past this at some point. So hang on to those properties. Now, the ones that did, it was quite funny, because some of the stimulus, like the home builders grant and things like that, in those growth corridors or in some of those estates, the land prices jumped by 20 or 30% when COVID, 20 to 30,000 when COVID hit us. So some of these clients that came back to us 6 months later and said, look, I'm feeling a bit more comfortable. And some, well, we can go back now and buy in that similar area. I can buy that similar type of property, but I just got to let you know that the land values jumped 20 to 30,000 even at the start of COVID because of those grants. So, you need to be careful. And then, of course, these are the articles that started coming out once confidence started to return to the market. It's all positive again.
But it's really important for people to get that. That's, I think, one of the key takeaways for people today is to get that fundamental understanding that you really do need to tune out media at all times. What we've seen from media like 12, 15 months ago with their dire forecasting is pretty much the norm. And it's important to understand that they're not necessarily trying to be helpful to clients. They're trying to induce people to click on headlines.
Absolutely.
You mentioned the 60 Minutes item. I was actually approached by 60 Minutes when they were putting that article together in which they forecast a 40% collapse in our property prices. And they said, this is what we're going to do and we'd like you to be involved. And I said, well, I don't agree with you. I think that's absolute nonsense. I don't think anything like that's going to happen. And they said, well, sorry, we can't involve you in the project then, because
Terry, I'm so glad you said no, because I didn't want to have your name up on that graph just then.
But I mean, the point was they decided the headline before they'd done the research. That it was a preconceived headline to generate sensation, and they cast around for people willing to say something that would support their preconceived headline. They can only find actually two commentators in the entire industry, neither of which had any credibility to support that thing. But it's indicative of what they do. And then we can compare what they were predicting back then with the actual outcomes. And I think that's a very important lesson for investors everywhere to understand that that's what happened. The people they should be listening to are people like you and perhaps people like me who bring a realistic, non-sensationalist, analytical, research-based view to what's going on and what will happen.
Absolutely. And look, and I think a lot of the viewers will agree that when we talk about investing, we're talking about where their markets are going to be in the next 5, 10, 15, 20 years, not where they're necessarily going to be in the next 6 to 12 months. And no one has a crystal ball either. So it's very important, to focus on the fundamentals. And then, of course, all of that leads into confidence sort of dropping off the cliff. So, people were concerned in the short term in particular, what was going to happen with their jobs, employment. And again, we're trying to explain to clients that, look, obviously there's going to be an impact to our markets. We don't know how significant it is going to be at the moment, but this is a supply issue. This isn't a normal market driver of a weakening market. This is simply a supply issue. You take the workforce, you take people out of the workforce, and we can't provide those goods and services. So this will only be short term. But absolutely, you had people pulling out of the market. You had people during lockdowns in certain states that couldn't even get out to open for inspections. So all of that led to a lot of people withdrawing, a lot of people sitting on the sidelines. But then, as you can see from that graph, it started to come back very quickly. Like once that stimulus kicked in, the government stimulus, once people realized that this wasn't Armageddon, it wasn't the end of the world, we'll get through this, particularly towards the end of last year. It was looking promising with the news reports around the advances in the development of the vaccines. You could see that confidence started to come back, and only just recently it's just dipped off a little bit just because of that Delta variant starting to play havoc again here in Australia. If we have a look at one of the other biggest driving factors, and I guess this was one of the key things that we try to explain to clients when COVID started to take off, is we try to explain to clients that as an investor, yes, it's a little bit uncertain at this time, but I do have a long-term view. But and although this was a tragedy for a lot of people who were losing their jobs, and obviously people were dying, and we can't ignore that. But in terms of the investor, and looking at the cash flows on their properties and the ability for them to secure finance, we now went from a situation where interest rates were historically low, and now they are virtually down to nothing. I think we're at 0.1% at the moment. So this was a massive, significant factor for investors, just giving them confidence around the properties that they hold, which I'll show as an example in the moment, but also improving the borrowing capacity of a lot of those clients or first-home home buyers that want to sort of get into the market. So that's probably one of the biggest factors that has really been sort of continuing to push the performance of our property markets nationwide. What are your thoughts on that, Terry?
I think it's a factor. I mean, as we've discussed previously, I've got a list of dot points. What's driving this property boom? I've got 16 different factors. The low cost of finance is one of them. There are multiple others, and I think that's why this property boom is so intense, why it's so compelling, and why I think it's going to have some longevity, because there are so many different factors feeding into it, and many of them are direct responses to the pandemic situation. You mentioned government stimulus. There's also a government rolling out a very, very big infrastructure program, both at state and federal levels, as a response to the pandemic situation to engender economic recovery through a big spend on infrastructure, because that generates so much for the economy as well as real estate. We've got expats coming back in large numbers because of the pandemic. We've got that exodus to affordable lifestyle, which has been given much greater impetus by the pandemic, and so on. So there are multiple factors, and the low cost of finances is kind of a bonus for people, because all that stimulus driving people to real estate. Normally, when things were pumping like this, the Reserve Bank might be lifting interest rates to try and quell things down, but because of the overall situation, they're keeping them very low. So that's just adding this extra element to what's already a very, very powerful force.
Yeah, absolutely. So this was an example that we showed some of the clients. So as I mentioned at the start there, when clients were calling in and they were asking, look, Jace, we've just purchased some properties recently. We're concerned. We've just only held on to them for a short while. What does that mean for our property? And I said, well, look, again, you've purchased this property for the long term, right? We're not looking to sell in the next 12 months or 2 years. It's a long-term strategy. But in terms of your properties, this was a client that had 2 properties. One of these properties they purchased in Brisbane, and the cash flows on that property, as you can see there at the bottom of your screen, we call that neutrally geared. It had approximately $20 cash flow positive income. This particular client also used some of the equity in their home to cover the deposit. So this is 100% finance. They didn't put any cash into this, but it was still neutrally geared, slightly cash flow positive. So of course we went back to all the clients and said, well, look, the interest rates have come down. You all need to go back and look at adjusting those interest rates or refinancing. So that's what the client did in this particular situation. And now we've gone from a situation where they've got over $100 there in terms of that cash flow positive income. So that was a bonus for a lot of the clients there. They're a little bit concerned that their cash flows on their properties actually improved, which was reassuring.
And one of the factors that's helping to drive that is the incredibly low interest rate, the incredibly low vacancy rates that exist around the country. That's another one of our factors, our 16 dot points, very low vacancy rates. It's hard to find a postcode around Australia that's got a vacancy rate above 1% at the moment, which means there's very, very strong upward pressure on rentals, which makes it a very good time to be a landlord in all sorts of parts of Australia, but also rising rentals also puts pressure on prices. So it's another big factor that's driving this boom and making it a really excellent time to be an investment property owner in Australia right across the board.
Yeah, absolutely. And then, of course, as you mentioned before, aside from the record low interest rates, you've got significant government stimulus coming in. So whether that's JobKeeper, those home builder grants, stamp duty concessions, there's concessions on lenders' mortgage insurance and various business support packages. I think this made a huge difference, particularly within the economy, but just people's confidence in general. But it created also some challenges for us. As I mentioned earlier, some of these clients that were buying brand new homes, some of the stock levels there evaporated pretty quickly because you had so many home buyers then wanting to cash in on that home builders grant. And a lot of those build contracts had to be secured by a certain date, which was towards the end of last year. So for those that stayed in the market during that period, as I mentioned earlier, they saw an immediate increase in their land lots that they would have secured at that time of up to about $30,000. And the others that sort of cancelled some of their purchases, but then maybe came back later, were quite shocked to find that had taken place. So again, these are some of the factors that just simply wouldn't have been there had it not been for COVID. Another interesting thing to point out is that, because of COVID and because of the lockdowns and because, confidence was low, people were saving a lot more. As you can see there, consumption dropped considerably. Savings ratios that were sort of hovering in around that 4% mark were now bumping up. Some people were saving as much as 20 to 30% of their take-home income. So again, for a lot of buyers out there or people looking to enter their market, particularly through 2020, this gave them the ability to obviously save for those deposits a lot more quickly. Now, unfortunately, those funds weren't flowing into the economy as they normally do, particularly entertainment and the food sectors and stuff like that. But it certainly gave those buyers a little bit more time and a little bit more of an opportunity there to get those deposits ready to go. And so where are we today? Like, who would have thought? And we talked about this earlier, Terry, like in our industry, we don't necessarily like to see the ebbs and flows. We like to see the market to be quite consistent. But it's interesting, even in 2019, when we saw a bit of a correction, nationally, it only really dropped the median price by about 9%. It wasn't a big deal. And then it recovered straight away later that year. And then, of course, COVID hit us. Market only dipped slightly. I think we only saw, and you could probably correct me on this, roughly 2 to 3% nationally, which obviously isn't much at all. And then it recovered quite steeply now. And as you can see there on the screen, and this was taken from the start of August, it's actually a little bit higher than that. I think Sydney now is up around 20%. You've got Brisbane there, it's sort of hovering around 18%, Adelaide's at 15%, Perth's 10%, and Melbourne's 10%. So in terms of how the markets are tracking now, we buy everywhere. So we buy in all the major capital cities. We've pulled back a little bit on Sydney just because it's so expensive and it's had a pretty good run. We still see some great opportunity there in Brisbane. We're currently buying in Adelaide. Adelaide is still a very consistent market. It just doesn't seem to capture the headlines, but in terms of investment, we do like Adelaide, and we've started to really sort of focus a little bit more on Perth. Also because of price point, we've been watching Perth for a little while. Vacancy rates are incredibly low, rents are on the rise. So there's some good opportunities, and we're very bullish about Melbourne as well. Just because, you can see the growth there from Sydney and Brisbane, which will start to taper off slowly over the next 12 months. But still, Melbourne is showing a lot of potential there for some upward trends.
Yeah. So the latest figures on prices out only yesterday by CoreLogic published their monthly report at the start of each month. So the report for the 1st of September, dealing with what happened in August and for the past 12 months, the most recent quarter, and basically in annual terms, the nation is up for house prices, up 21%, regional markets collectively 22%, capital cities about 20%. I mean, it's strong across the board, and the most recent quarter and the most recent month shows the numbers are still rising at unprecedented levels. So, there's no sign of slowdown. It's just another one of those issues where there's a dichotomy between what's actually happening and what media is telling us, because there's a bit of a competition by various commentators to try to be the first to call the end of the boom.
Yeah,
we actually saw that happening back in March and April of this year, when some of the month-to-month figures were a little bit lower than the previous month. So people were saying, aha, the end of the boom. But they continue to roll on. Here we are now in September, and we're still getting these extraordinary numbers. I don't think it's going to slow down anytime soon, because as we've already articulated in this broadcast, there are so many different strong forces driving this thing. It has some longevity.
Yeah, absolutely. And look, it's interesting too, and we talk about this a lot. We purchase properties in all those major capital cities, but we also target all the regional areas throughout Australia. And it's been very interesting, the emergence of those regional areas, particularly over the last sort of 10 years. And even now, as you said, for those regional areas to still have the same levels of performance of some of those major capital cities is quite incredible. Yeah,
absolutely. And I think, what we've actually seen over the past several years is the rise of the regions. We call this trend the exodus to affordable lifestyle. And media, again, has portrayed it as a response to COVID. And what we know by looking at the numbers, it's actually been underway for quite some time. Yeah. It's just that the pandemic has given it greater focus and perhaps given it greater momentum than it previously had. But it was definitely underway that the biggest cities were losing population to what they call internal migration, people moving to other parts of Australia. A lot of it's going to, some of it's going to the smaller capital cities like Brisbane, but a lot of it's going to the regions, not just coastal areas, but some of the regional centres, and the hill change towns and the bigger regional centres like the Ballarats and the Bendigos and places like Orange in New South Wales, Toowoomba in Queensland. And so it's powerful, and it's driven fundamentally by technology and the ability to work remotely, and people's desire for lifestyle and affordability.
It's interesting because you talk about that and some of the impacts with COVID, and you mentioned it before, that this whole this whole way of working now in terms of remote living, it's quite interesting. People now are asking when they look at the floor plans, where's the Zoom room? Where can I work remotely now, which is something that we sort of didn't experience too much, which is opening up some opportunities, because now you have situations where people don't have to work live as close as they originally would like to have lived in terms of the CBD areas and things like that. They can move further out into those outer suburbs because they might only have to travel once or twice a week to come into work. So, and also just these regional areas, it's created a lot of opportunity because due to affordability, a lot of our investor clients just simply can't afford to invest in some of these larger major capital cities. It's just not in their price point anymore. So again, to open up some of these regional opportunities in terms of affordability and get clients in there, but still know that there's still some good capital growth and high yields, that has created some opportunities.
Yeah, we like to call buying in a good regional centre a win-win-win opportunity, because the first win is you've got that lower price point you just alluded to. The second one is that you generally will get better rental returns. So you've got that greater prospect of being positive cash flow. And the third one is you're going to get really good capital growth if you choose your regional location well. And so I think some people are making the mistake of just buying randomly to get a part, driven by the FOMO syndrome and not giving too much. So I think it's very important in these times for people to have expert advice. They need to be talking to people like yourself and your organisation to make sure that they're buying in the right place, taking a longer term view, because sure, you might get some growth in the next 12 months because everywhere's growing, but what about next year and the year before, the year after that, 5 years from now, 10 years from now? It's important to choose your location extremely well, even in a runaway property boom like the one we have at the moment.
Absolutely. So as we've discussed, no real end in sight, certainly in the short term, in terms of where the markets are at. Now, this is a KPMG report that I was looking at just the other day, just talking about sort of where we're sort of heading, in the next few years, and talking about some of those stock shortages as well, particularly with the boom that has also been driven by COVID. And you can see there that Victoria and also New South Wales has some deficiencies there. And again, that's why I mentioned sort of earlier, we aren't doing a huge amount in Sydney at the moment because it's just so expensive, but certainly Melbourne we're having a closer look at as well. So that sort of gives a bit of an indication of some of the pressures that we're still going to experience in terms of supply over the next sort of 12 to 18 months. Having a look at this is interesting too. This was another graph that they put together just showing where they sort of expected prices to fall without COVID, without us having to experience COVID, versus obviously where we're at today moving forward. You can see there that the blue line, the blue graphs is pre-COVID, post-COVID is the light blue. So you can see there that what they've been indicating throughout their data and reports, that because of those two big main factors being the stimulus and lower interest rates, etc., factors that wouldn't have been there had it not been for COVID, and now consumer confidence is back, we're actually experiencing better performance from those markets had we not experienced COVID at all. So that's very interesting to see that. I think most people would be surprised to think that COVID, particularly at the start when we started to experience this, if anyone would have said, oh no, I think that because of COVID, we're going to experience better performing property markets, I think most people would have laughed at you. But that's what the data is showing us.
And we understand why that's happening because there are so many powerful forces behind it. We've articulated a number of them: the exodus to affordable lifestyle trend, the level of government stimulus, including the infrastructure spend, the expats coming back to Australia in large numbers and buying real estate. Foreign investors now starting to become targeting Australian property as well. That's another factor that's starting to come in. So there are multiple forces, and many of them would not have been in play were it not for the pandemic. And that's the point that's beautifully made by the graph that KPMG put together.
Yeah, absolutely. And look, and we've discussed this too, and we've talked about commissioning you guys to do some research around the impact of the international borders opening up as well, and what that impact might look like on our markets. The report talked about the fact that, and they even showed a table showing the forecasted population growth, which obviously is another another factor to consider when you're talking about demand. And they did show that because of COVID, they're expecting over the coming years that our population will be less. And a lot of that does have to do with the fact that, our borders are closed and we're not taking in those international migrants. But even with some of those factors, the fact that interest rates are at record lows, we've got all this stimulus coming into play, and confidence is still incredibly high, that those factors were still stronger than the fact that we don't have a lot of migrants coming into the country at the moment.
And the numbers show that the expats coming back have more than compensated for the lack of overseas migrants. And watch out, everybody, for the second wave when our international borders do reopen.
Yes.
There is going to be an avalanche of overseas migrants wanting to come to Australia, and that's going to create what you might call a second wave of demand that's going to extend the current upcycle, I believe. It's just a question of when that's able to happen.
Yeah, absolutely. So then a lot of clients do ask us, what are your thoughts about going into next year in terms of, where you see the markets? Because obviously, look, for the moment, as we say to all of our clients, and look, we say to our clients, look, as long as you've got a deposit, as long as the bank will lend you money, as long as you have a little bit of a buffer left over, you should be buying it as soon as you can afford to. Because it is for the long term. Having said that, as we discussed earlier, there's still going to be an upwards trend here going into next year. My view and some of the research that we've done is it will start to taper back going into the later parts of next year. What are your thoughts in terms of what's going to happen next year?
I think we're going to still have prices rising well into next year and probably into 2023.
Yeah.
I note that ANZ in the past week have published their latest forecasts, and they're predicting growth averaging about 21% this year, further growth next year, but at a much lower level. And that seems to be the consensus amongst the major bank economists, at least.
Yes.
And I think that I think they're probably being a little bit pessimistic with the level of growth they're predicting next year. But I think the significant thing is they do expect prices still to be rising next year, just at a lower rate. I think that generally will be true, but I think we're probably still going to be seeing many markets doing double-digit growth next year on top of what's happened this year, because many of these markets are just getting started on their upcycle. Some, like, say, Hobart's been showing strong growth for 3 or 4 years. Some of the regional markets, Victoria, like Ballarat and Geelong, have also, the Sunshine Coast has had 3 years of growth. But most locations in Australia are really just at the start of an upcycle. And these upcycles, normally, we know from what happened 20 years ago and what happened in the late 80s, when we've had back then also major national property booms, that these cycles tend to run for maybe 3 years of upwardness, and then we have perhaps a correction period, usually a fairly minor one. So most locations in Australia are really just in the early phases of an upcycle. So I wouldn't expect it to slow down anytime soon. So those people, we hear a lot of it, investors saying, look, I'm just going to wait till it all settles down before I buy. If you wait 12 months and then hoping that things will settle down, you'll be paying potentially 20% more for the same proproperty, which is why it sounds a little bit spookerish to be saying it, but I think if you're ready to go, you should go now, because 12 months from now, you're going to be paying a lot more. And we're hearing it from people right now saying, I was thinking of buying 12 months ago, but because of all the negative media, I decided to wait.
Absolutely.
And I wish the hell that I'd acted then, because everything is now 15, 20% more than I could have paid back then.
Absolutely. And look, we had the same issue too. Like, a lot of clients were saying to us, look, I absolutely want to get into the market, right? But I just want to see what happens. And I said, well, look, and the question I ask a lot of my clients, you're doing this for the long term. So if you don't think your properties are going to be worth more in 5 or 10 years, don't invest in property. But don't be just focused on the capital growth. Like the record low interest rates, let me show you a PI report. If you buy this property today, and let's assume you don't get any growth in the next 12 months, for argument's sake, these properties can still generate anywhere between $5,000 to $10,000 in cash flow positive income, right? So, obviously those capital gains are a big factor. That's how we generate our wealth over time, but we can't ignore the cash flow positive income that can also be achieved on those properties. So that's something that can't be ignored. And look, yeah, you don't have a crystal ball. No one's got a crystal ball. Even when these predictions started coming out, once people started becoming a little bit more comfortable with COVID and consumers, confidence returned, I don't think anyone would have thought that we'd be this far ahead in terms of where the property market is at, with still more growth to come. But this is where we are. So absolutely, if you've got deposits, the bank's going to lend you the money, if you've got a bit of a buffer and you're getting some professional advice and some assistance, and they're reading your reports, Terry, on the locations and all that sort of stuff, and they're doing their research, you just got to get out there and get amongst it.
You do. And you do need to exercise some patience. I don't think there's a single market in Australia where there's produced big growth every year for 10 years. That doesn't happen. There's always periods for every location and every cycle where there's a lull, maybe values come back a little bit. You need to take the long-term view and be patient. I'm thinking with reference to what you've just said, of property that I own in a regional centre in New South Wales, which I bought some years ago. It hasn't done much with capital growth, but the rental return was 8% from day one. So it's been wonderful, positive cash flow property. And now the reason I bought it there was because of the inland rail link. And they're now building that section of the inland rail link, a huge piece of infrastructure, which I knew was going to be a game changer. And now we're seeing like 30% spikes in property values in that location, which up until this point had not performed, but I knew it would eventually. And in the meantime, I had that wonderful positive cash flow from an 8% rental return. So, yeah, I think the point you've just made is a very, very strong and valid one.
And I think the diversification is just so important too. Like, it's quite interesting because we're not normally talking about all our markets rising nationally at the same time. Like, as you know, there's markets within markets, and often, and a lot of the data has shown that the states can tend to operate on different property cycles. And this is one of our big arguments for explaining to clients or recommending to clients that we chase the markets nationally. If the market's doing really well in Brisbane, or it's looking like it's going to do well, let's buy in Brisbane. If it's looking like it's going to do well in Adelaide, let's buy in Adelaide. It doesn't matter that we don't live there. It doesn't matter that we don't necessarily know the market, unless provided we do our research, or we've got groups like us to help us with that research, because again, we don't have a crystal ball. And over time, it's quite funny with our clients. Like, we buy them properties over the years and we do portfolio reviews. And I might help a client buy a handful of properties, and then we do our portfolio reviews a few years later. They're like, oh, these ones really took off. Maybe we should have bought more there, Jason. I said, yeah, but we don't have a crystal ball. We didn't know for sure. And then what happens a few years later, they're back in the office. We're doing our portfolio reviews, and those ones that took off are slowed down, and now the other ones are taking off. So sometimes you just don't know. You can do all the research in the world, and still not know for sure how these markets are performing. So that's why we spend a lot of time teaching clients on how to build portfolios, not just relying on one property and just hoping that that's going to set you up financially. It's just not the case. You need to build a portfolio, and that's why you should target the markets nationally.
And the key word, I think, often is diversity. You need diversity in your portfolio, diversity of location as well as other kinds, to cover the fact that you've just articulated, that if you've got a diverse portfolio, you're always going to be having growth somewhere in your portfolio, because that's the way things
absolutely
work in real estate. We better keep moving through the presentation, Jason. We've got quite a few questions that are coming in.
Yeah, for sure. So I just want to let people know that obviously, in terms of what Terry and I do, Terry obviously puts out a lot of research. We work very closely with Terry, and we leverage off Terry and his research team. We've got an internal research team, and there's also Terry's team in terms of all the property reports and data. But generally off the back of these, I know people have got some questions now, but if you want to have a deeper dive in terms of what you can potentially do, or what the opportunity looks like to build a property portfolio, our team can help. So we've got a complimentary session. It's normally valued at $500. It runs for 90 minutes. It's one of our property wealth planners. We can obviously do it over Zoom, etc. And in that session, we're going to sit with you, either have a look at your current portfolio if you've already got one, or if you're just starting out, really teach you guys how to set up a property wealth plan, how to set up all the structures, how to target the markets nationally, give you a rundown of all the markets nationally, give you access to all our educational platforms, ebooks, videos, location reports, and the strategies there, and also some of those best locations, also leveraging off a lot of Terry's research and data as well. So those options are available. Before we go into these questions, you can access that through our website or give us a call. and we've got offices in Sydney, Melbourne, and Brisbane. So, Terry, we might come back to some of these questions now. I'll just exit out of this screen for the moment.
Okay. Yeah, we're getting, as we often do, so many of the questions relate to locations that people might be interested in. I've got a question from Philip, who's wanting to buy an investment property in Brisbane with good growth opportunity. He's asking, do you think I've missed the boat in Brisbane? And if not, which part of Brisbane presents good opportunities? I think Brisbane is one of those places that's very early in a major growth cycle, and there's lots of reasons for that. We could have a whole seminar just on Brisbane.
Yes.
But I think the announcement about the Olympics is going to mean that Brisbane and Southeast Queensland are going to have a sustained period of growth for the next 10 years, in fact. It was already rising anyway. But what are your thoughts?
Look, absolutely. Brisbane's one of those cities where for many years now, we've all been talking about, this is Brisbane's time. As Sydney and Melbourne always seem to take the limelight, it was like, when is Brisbane going to really start to surge? And it's only been recently that's really sort of starting to take place. And why wouldn't it? You in terms of lifestyle, it's a beautiful place to live. In terms of affordability, where people are paying $1 million plus in terms of the median price down to Sydney, and then they can go into Brisbane and get something for around that sort of 500 or 600 in terms of the median price. It's super attractive. And then, of course, the interstate migration. There's been a massive surge. I think they're taking in more interstate migration than any other capital city at the moment. So, yeah. And we've talked about this. You're gonna do some research for us. You're gonna really deep dive on the impact of the Olympics as well, and we've put out some content on that too. So absolutely, in terms of the short term, yes, absolutely. There's still some growth there, and the yields are high. For example, our Victorian clients really get a surprise when they look at the stamp duties. You're looking at 3% versus 5% in places like Victoria. So, there's some considerations there. Yeah. But as a long-term strategy, absolutely.
Yeah. And I know you haven't missed the boat, Philip, at all. I mean, there's certainly been some growth in Brisbane already, but I think, as I said at the beginning of a growth cycle, which I think is going to be extended because of the impact of the Olympics and all that's going to unleash in terms of infrastructure spend and focus on Brisbane and Southeast Queensland. Maria's asking, Jason, do you have any data on regional cities in New South Wales like Dubbo, Orange and Bathurst?
Yeah, so I don't have that data on hand, but in terms of Sydney, the biggest challenge we have with investing in Sydney is just affordability. Most of the clients that we purchase properties for, we don't start with a location or a property. So what we start with is the client's financial goals and also their ability to secure finance. So the strategies that we recommend are purely to do with what sort of property do we need to purchase in order to enable you to keep growing on this portfolio. So what do the banks need? So in some instances, the client's borrowing capacity might be quite low and they might need high yields to support future purchases. In other situations, you might have high income earners and they've got plenty of equity or plenty of cash, so their price points can be a lot higher. And that's where like a market like Sydney would still be an option. But certainly in some of those regional areas, we did quite a few, we purchased a lot in places like Newcastle and some of those larger satellite cities throughout New South Wales. But as we discussed earlier, a lot of those regional areas are doing really well, but we tend to like to target areas that have at least 100,000 people in terms of a population base, just to provide us a little bit more stability in terms of those local economies.
Yeah, sure. And certainly, we're a big fan of Orange, which is a substantial regional city that has that diversity, if you like, in the local economy, not too far from Sydney. It's getting a lot of those affordable lifestyle buyers. It also has a number of major state government departments headquartered in Orange, not in Sydney, but in Orange. Dubbo's always been a very solid performer, a very important regional city with some substance. We've had a couple of people asking questions about Toowoomba in Queensland. That's certainly one that we've had some focus on. Are you finding interest in places like that, Jason?
Yeah, we tend to still focus in terms of where we're buying is still in and around Brisbane. So we still see a lot of opportunities in Brisbane. As I mentioned before, we purchase in a lot of the other major capital cities as well, Melbourne, Adelaide and Perth. We haven't ventured too far into the northern suburbs, just particularly recently as of late because of the performance of Brisbane. But certainly we keep a very close eye on some of those markets. Sometimes those markets can be a little bit more volatile, particularly some of those smaller regional areas. But certainly there's opportunity all the way up the East Coast there.
I think a key message for people to take away today, and you've mentioned it a couple of times, is you need to buy in locations with substance, with a certain critical mass in terms of their population size, particularly in the strength and diversity of their economies, because we're seeing too many investors buying randomly at the moment. They're buying in small country towns because it appears cheap and prices are growing, so why not grab some of that? Sleepy coastal villages that might look sexy, but do they have the substance to drive values and provide growth long term? And I think it's really important for people to get that message. I've said it earlier in the broadcast, I'll say it again, you need to be very fussy about your choice of location. And Jason's point about buying in locations that have critical mass and substance is really, really important.
Yeah, absolutely. Because look, and without knowing the financial position of your viewers, like there are some clients there that when they're starting their portfolio, they've got plenty of capacity, they've got strong borrowing capacities, and they've got plenty of equity or plenty of cash, right? So even if they buy a property and it doesn't perform exactly how they intended in terms of capital growth, they don't need to rely on the growth to buy their next one. They can easily tap into their cash or equity and cover deposits to get their second or third. But for those of you who are starting out with your first investment property, and you don't have a lot of surplus cash or equity to leverage off, it's really critical how this property performs, because you can't save yourself the wealth. You can't save for your next deposit for your second property. You really need to rely on the capital growth from that first purchase to help fund those deposits when you draw on that equity to help you get your second, and then create that compounding effect over time. So that's why, look, sometimes we love cash flows too. Cash flows are great, and cash flows make clients feel really comfortable. But again, if that property is only generating $50 or $100 a week, well, let's call it $100 a week, that's still only $5,000 over the next 12 months. Over the next 2 years, that's $10,000. It's still not enough for a deposit. You still want to get some capital growth. You still want to be able to draw on that equity to supplement those deposits for your next purchases. So both those factors are super important.
Yeah. He was asking about Melbourne. When will Melbourne catch up the other capital cities after lockdown? I don't know that Melbourne's actually fallen that far behind the other capital cities. It's showing incredible resilience. And again, we would refer to those points made earlier that prices are rising because of the pandemic. Remember that, not despite it. And Melbourne's a bit of an example of that, don't you think, Jason?
Oh, absolutely. Look, we're a little bit behind, but at the same time, I think we're into almost our fifth month now in terms of lockdown. So I don't think it's a question of demand. It's just that, physically, particularly if you think about a lot of the established properties, people just couldn't get, that we were locked down. We couldn't get out to view properties. Auctions were shut down. You couldn't inspect the properties. So we have had a lot more disruption there to our market in terms of physically inspecting properties than, say, the other states. Like, look, Brisbane, I think, has only had a lockdown of, say, 10 days. Sydney is obviously in lockdown now, but still they still can inspect properties. Where here with Dan Andrews, he's quite tough on us. That's it. You can't go anywhere. You can't leave 5 Ks from your home. You can't get out open for inspections. You can't go to auctions. You can't do any of that. So that's something that's also impacted our markets locally. And look, as I said before, and we touched on this, our markets were fundamentally strong. So COVID has only delayed the inevitable in terms of what we were expecting from our property markets. But because of lower interest rates, because of stimulus, it's added an extra kicker or factor to those already strong fundamentals.
Yeah, and just looking at the numbers for Melbourne, published yesterday by CoreLogic, house market, up 1.4%, median prices in the month of August. For the most recent quarter, up 5%. And for the year to date, that's the first 8 months of the year, 15% rise. I mean, that's not a slowdown. That's a market that's still performing pretty strongly, and there's growth also happening in the apartment markets. Not as spectacular as that, but nevertheless there is growth. So Melbourne, and we've seen from the previous lockdowns in Melbourne that Melbourne's come out of lockdown, with all guns blazing. It gets back to strength very, very quickly. People want to get out and get into the cafes and restaurants and do things and get back to work. So I think
Absolutely. And we can't ignore the FOMO. Like, confidence is back and people are seeing what the markets are doing, and the FOMO out there amongst first home buyers and investors just scrambling to get access to stock, particularly in Melbourne, and they can't at the moment. It just compounds. So again, great times for investors wanting to get into the market and just get in as quickly as you can.
Yeah, and that's a very nice segue into the next question, which is, I was wanting to buy an investment property at the end of next year, 2022 in Brisbane. Would that be too late for me to buy? And I think the question that I would want to ask that customer is, why are you planning to do it at the end of next year, and why not now?
Yeah. And then there's the question of too late. What does too late mean? So look, the only time I would suggest clients might want to consider putting off a purchase is it's absolutely obvious, or the data is heading in the right direction, that we are in some sort of decline, right? Which is hard to predict. But again, like, even if you purchase towards the end of the next year and going into 2023, we didn't see as much growth, you're still investing for the long term, all right? So you always invest when you can afford to. That is the rule with long-term investing. You don't try to pick the markets. It's incredibly difficult to do. And then, of course, coming back to your question, what are you waiting for? I don't understand why you would be waiting. I would absolutely recommend that you look at getting into the market now.
And one of the oldest cliches in real estate investment, but it's also extremely accurate and viable, and that is, it's not timing the market, it's time in the market.
Correct.
And people who try to time the market usually come a cropper, because, as they say, no one rings a bell when we reach the top of the market or the bottom of the market. The signals that will tell you when the right time to get into a market, usually there's a delay of 6 or 9 months before that data comes through. So people who are sort of waiting around for signals for the right time usually miss out. So I just repeat that cliche, it's time in the market that's important, not timing the market.
Yeah, absolutely. And look, as we try to teach our clients, like, it's not just about that one purchase too. Like, one of the things that we really focus on is making sure that the properties the clients are buying are tailored to their circumstances. We don't want to enter into a purchase that's going to have a negative impact on your ability to borrow for the next one. So it's not just about one purchase. You're not going to achieve significant financial goals by buying one investment property. You've got to look at how to structure a portfolio over time. And that's what we really focus here at AllianceCorp, really showing clients that, look, this is where you want to get to in terms of your financial goals. And in order to achieve that, you're going to need approximately this amount of properties purchased over this amount of time. Okay, now let's look at your financial circumstances. Let's do some forecasting and see what's achievable. That is critically important, just about, rather than just going, oh, where is that one absolute great location? I'm going to buy that one property, and for some reason, if I'm able to achieve that, I'm going to achieve my financial goals. So it's a portfolio over time, and it takes time.
Or I found this great location, I'm going to buy property. Now I'm going to buy another property in that same location. Then I'm going to buy a third. It's amazing how many people get caught because they've bought multiple properties in one location and it turns out to be a dud. And they suddenly have a problem that's very, very difficult to recover from. Just with reference to our earlier comments about the importance of buying in locations with substance and diversity and strength in the economy, Thomas is asking about coal and iron ore production. Any thoughts about Gunnedah in New South Wales, Whyalla in South Australia, Bowen in Queensland? And I would have a bit of a warning, a general warning when people are thinking in those terms.
Yeah, absolutely, because you'd have to be an expert in the commodity markets, and I know a lot of investors got burnt during the last resource boom. It's incredibly difficult to sort of pick because it's just so volatile. All right. So look, if you feel that you're an expert in that field, if you feel you have confidence in understanding the commodity markets better than most, and you're happy to take on that risk appetite, well, then that's up to you. But that's certainly not something that we recommend. Look, a lot of our clients invest in the background. They don't give up their day jobs. They don't come to us and say, look, I want to quit my job and become a professional property investor. All right. So they don't want to take on a lot of risk. We're investing for the long term. And we don't speculate. So if clients comes to us and say, look, you're going to put us in the right direction. We're going to buy a property today. We're going to sell it in 12 months and make all this money. We say, we don't do that, right? So everything we do is about building a portfolio over time. The old saying, you make money while you sleep, right? It's just, these are low risk strategies. you structure your finance correctly, you do it in a way where the properties don't impact your lifestyle, so you're not having to constantly put your own money in. You can turn your equity over and do all these other strategies. You can use a mass facility. So it's not something that we generally recommend either.
Yeah. Look, we're just coming up to the hour, so we need to wrap up shortly. Let's deal with just one last question before we wrap things up. Well, I was asking, what are your thoughts on Western Sydney suburbs, knowing so much about the big infrastructure projects that are happening or due to happen in the next few years? What are your feelings about Western Sydney?
Yeah, absolutely. It comes down to affordability again. Most of the clients that we deal with have a price point or price points that we usually target anywhere between 400, which is getting a lot harder now. 400 might, we'd be looking at some of those regional areas, or we'd be looking at some of those established properties. To get new properties or off the plan properties, it's very difficult to do in any areas across Australia, particularly because the construction costs have gone up considerably. That is one factor of COVID. But those price points can extend from 400 right up to about sort of 700 to 800 in some instances. So it really comes down to the client's current financial position in terms of what they can afford. But if you want to get into Sydney, you've got no choice. You've got to start branching out into some of those western corridors. Due to affordability, you've got no option. So absolutely, there's some opportunities there. But at the same time, I can't ignore what's happening in some of those other markets that still have got a lot of upwards pressure, but haven't yet pushed through that 20 plus capital growth mark. So that's why we're targeting some of these other cities as well.
Yeah. Like sometimes I say to people, if you're looking for a simple formula as a strategy, follow the infrastructure trail, buy property that lies in the path of progress, and that's certainly is Western Sydney. There's just so much happening out there. And still, by Sydney terms, offers good value for money, and there's a lot of growth potential just through the enormous infrastructure spend. Not just the new airport, but there's an awful lot of other things happening out there.
Sure.
Now, I just refer people as we begin to wrap up to the chat box where we'll put up the link to click on if you want to find out a bit more about the special offer that Jason has told us about earlier. If you click on that link, it'll take you through to that offer. But perhaps you could just reaffirm for us, Jason, what that involves.
Yeah, absolutely. So guys, it's all about, having confidence. It's all about getting educated. It's all about getting some good, solid professional advice. So that's what we do. We have a team of approximately 50 spread around Australia who specialize in helping you guys with that. This offer is roughly 90 minutes of education. All right. So you come to us, you tell us what your goals are, and then we start to work through a bit of a strategy in terms of how the finance would work, what sort of properties are best suited to allow you to build a portfolio, and then giving you what's called a property wealth plan. So it's a drafted property wealth plan. It's a bit of a blueprint to show you what you can do over time and how you would structure it. Now, beyond that, if you want some more assistance, if you want to build a portfolio nationally, well, then that's where you can become a member of ours. And our acquisitions team, our property wealth planners, our researchers can help you buy these properties nationally, whether it's established properties, new properties, off the plan properties. And then we continue through our lifetime membership to meet with you each and every year to review your portfolios and keep helping you buy those properties nationally and chase the markets where they're doing well. So if you want to really supercharge that, or you want to get some real confidence, book yourself into this session. It's completely complimentary. And again, you'll walk away with all these added benefits and ebooks and videos and all the rest of it.
And I would say also
the website. So it's AllianceCorp.com.au.
There's a lot of questions we haven't had time to get to, Jason, but a lot of them actually are questions which I think would best be handled in the kind of strategy session that you're talking about. Stephanie is sort of asking about, how much deposit do I need?
Absolutely.
Shirley's asking, how much would you suggest you start a property portfolio? There's a lot of questions that relate to general strategy, but are specific to your individual situation. We can't really answer those effectively in a forum like this. What you need to do, I think, is get involved in one of those strategy sessions that Jason and his team are offering. And you can have a discussion purely about your situation and get something designed for your situation. So I think that's the best way to move forward. Apologies that we didn't get to deal with all those questions, but there is a way forward for you, I think.
Yeah, because it's funny, like a lot of people, they want to talk property, Terry, but 80% of the discussions we have in our planning stages It's about finance. It's about structuring the portfolios. The properties themselves are just a neatly packed pile of bricks. So you're not going to live in them. We don't want to get emotional about them. It's just about using that vehicle, property investment, to achieve your financial goals. And that's what 80% of our discussions are around.
Well, I think that's a great note to end this broadcast on. Thank you, Jason, for a great presentation. I think it's been, I hope, and I certainly think it has been very useful and interesting for people out there watching. We had great numbers registered for this event, so I think a lot of people are going to get some good information and good advice. But I do urge people to follow up and to take advantage of that offer of a strategy session where you can talk about your own personal situation, maybe get some answers to the questions that are in your mind. So
absolutely. Fantastic, Terry. Thanks for having me.
No worries at all. Thanks, Jason, and thanks everybody for participating. Let's do it again soon. Bye for now.
Okay, bye.